to our second discussion point today, the Finance Act. Depending on the macroeconomic policy of the federal government in any financial and fiscal year, amends relevant tax laws and related statutes, including the Capital Gains Tax Act. The issue of capital gains tax in Nigeria's capital market has come to the fore. Government from time to time has the responsibility of reviewing the tax position as a component of the subsisting fiscal policy for the purpose of meeting given objectives. However, each review of the Financial Act naturally elicits mixed reaction from stakeholders on the CGT, as some argue that the introduction of capital gains tax in Nigeria capital market will affect investors' interest. The capital gains tax is a levy imposed on gains arising from the disposal of chargeable assets in relation to disposal, acquisition, and or sales of shares, bonds, stocks, and securities in Nigeria capital market. A little bit technical there, but let's get more insight and understand what this means. I told you earlier, he's live in the studio. He is the senior manager and head of advisory and transfer pricing services at Pedalboard Professional Services, Mr. Fidelis Chukwu. Thank you so much for your time. It's the first time on the show. We appreciate you.
Thank you, Tolu. Good afternoon.
Yes, we've talked a lot about Finance Act, but let's talk about this reintroduced capital gains tax on disposal of shares. Let us understand what this means. Shed more light on it for us.
Okay, thank you. Yeah, capital gain tax, like you mentioned, is the regulatory framework for taxing investment income per se.
Okay.
That's gains derived from your investments and not the gains on your day-to-day business activities. And Finance Act 2021 happens to be the third to be issued in the last 3 years. Since 2020, which government issued a Finance Act for 2019, and we've had 2020, and this is 2021. The Finance Act over these last 3 years have made a lot of changes to our tax laws. And these changes, like you know, are brought about giving incentives, withdrawing the existing incentive, and kind of imposing new taxes and making a kind of other provisions in order to align our existing tax laws with the everyday changing business environment. As you know, some of these laws were written. In fact, the Capital Gains Tax Act was a 1967 act. And over the years, we've had a series of amendments here and there to the act. So the Finance Act every year continue to update all these laws in order to bring all these laws to current realities. Now, Capital Gains Tax per se, the law, like I mentioned, was a 1967 law. And you know, over time, a lot of things have changed here and there. Now, prior to 1998, gains from disposal of shares were liable to capital gains tax.
Okay.
Now, in 1998, the government at that time, in their own wisdom, said that, oh, let's encourage capital market participation so that people can invest in companies through shares. And from there, they then decide, okay, what incentive can we give? So in that 1998 government, then through the Finance Miscellaneous Provision Act of 1998, amended Section 30 of the Capital Gains Tax Act. And through that amendment, then granted exemption from gains arising from disposal of shares. So since that 1998 up to 31st December 2021, investors do not necessarily need to bother about, oh, I'm investing in a company or in the capital market. When I want to exit, what will be the challenges about that? So that concern was not there.
Yes.
Because they all know that, oh, if I want to exit, I just need to sell my shares and I walk away with my money. So that fear was not there. But government then look at it that, okay, there are a lot of issues, you know, like businesses are evolving every day. People speculate, go into the market, invest, sell, pick their money, move on, especially some of the foreign investors. Government then look at it that, number one primary objective for tax that we should know is that government needs revenue.
Of course.
Because over time you see that oil that used to be our mainstay is not, the prices keep going on going down every day. So government is looking for revenue. That's number one objective. So government probably look at it that, oh, from a capital gains that people are selling shares, they are walking away with their money. How can we collect part of it? Now government decide to amend that provision, that exemption granted that removed gains from that share, the government decided to say, we are taking this exemption away. Which then means that from 1st January 2022, if you sell your shares in any company in Nigeria, you are going to be liable to tax on the gain you derive from that disposal.
On the gain.
On the gains, not the entire amount you sell. Of course, you can sell without making gain. But if you make profit, let's say you invest 2 years ago, you invest, let's say you invested 100 million 2 years ago, and this year you are selling for 150 million. The 50 million, exactly, you are going to be liable to capital gains tax of 10% on that gain you derive from that. So that is just the amendment that has been introduced. So going forward, once you sell your shares in any company, whether in private company or publicly quoted company, you are going to be exposed to capital gains tax. Yeah.
Very interesting, brilliant. More clarity even for me. We, the journalists, will get to really learn. But now that the CDT is applicable on disposal of shares, are there any concession granted to investors, or are they all disposable now liable, or disposals now liable?
Yeah, there are concessions. There are concessions because, of course, government also look at certain things or criteria or issues in the economy before coming to the decision of imposing this CGT. And the primary objective, again, is that government also still want the economy to grow. Not tax is one of it, but then government is still mindful that we need the economy to grow. Now, part of the concessions that government has given is that, one, if you are disposing your shares and the value of the shares you are disposing is less than 100 million, then you don't have to pay capital gain tax.
Okay.
It's exempted. Once the value is less than 100 million, and this is over 12 months. So if you sell, let's say we are in May 2022, between May 2022 and April 2023, if the total proceed as an investor you derive from selling your shares for that period is less than 100 million, you are exempted. But immediately you cross that band of 100 million, you are liable to CGT. So that is the first concession. People with a proceed of less than 100 million, they are exempted. The next one is that, like I mentioned, government is also mindful of the economy. They want people to invest. Now, if you dispose and you reinvest, no matter the magnitude, no matter the volume of that disposal, so long as you are reinvesting in that same company you are disposing your shares, or in another company in Nigeria, you will also not be liable to capital gains tax. Let's say you sell shares worth 500 million in company A, and you decide to go to company B and invest the same 500 million or more. You will not be exposed. The capital gains tax will then come up the day you then decide at the three concessions given under the capital gains tax, as it is that if you fall within that three categories, then you are not going to be liable to capital gains tax.
Interesting stuff. But do you foresee any challenges in the implementation of this new provision?
Yeah, of course, there are challenges. There are challenges. You know, like I mentioned, since 1998, we've not had capital gains tax on shares. Now, government has introduced it. You know, in our own economy here, our tax system is evolving. Issues keep coming every day. Taxpayers are having issues. Administrators are having issues. So we don't even have an accurate database. Compliance is very low. Now government has introduced tax on shares, disposal of shares. Who is supposed to pay the tax? The person making the disposal is the one to pay the tax. Now, the first issue is, for corporate entities, it may be very easy for government, for tax officials to track, oh, you have sold, you have invested, because a company will usually prepare financial statements, and in financial statement, we see all those information. But for individual, how do you deal with that? An individual that disposes shares, probably he has not even registered for tax in any state. Okay, so, and you expect such person to then willingly go and compute tax on the shares and pay. You know, somebody that is yet to even register, is not even in the tax there. So that is the first challenge. How will the tax authority track transactions regarding individuals. It's a major challenge. Okay, that is one. Another issue again or challenge that we may also have is that the law amends this section 30 of Capital Gains Tax Act. Your shares, when you dispose, will be liable to tax. Another section of the act has provided for how do you compute the tax, which is the costs and other expenses you incur in acquiring that shares, selling expenses. You need to claim all this as part of your cost when you are selling. But when you look at shares, there are peculiarities. For instance, somebody invested, let's say start a company 20, 30 years ago, and as at that time his share capital when he started that business 10, 20 years ago is just 10,000 naira as at that time. Today the company has grown, is now worth 1 billion. Are you really going to say that the cost of that company is 10,000 naira that the person invested 10, 20 years ago?
No.
It's one issue. Another issue or challenge again is this amendment to section 30 again, especially the reinvestment of proceeds, kind of creates a kind of is discriminatory per se, let me use that word. Because when you look at other assets in the Capital Gains Tax Act, the law provides for what we call a rollover relief. And that rollover relief is also the same as when you dispose and you reinvest. Then you are not going to pay tax. But when you then look at other assets, you are allowed to take investment 12 months before your disposal or 12 months after your disposal for the purpose of that relief. So if you invest, let's say you have to say that, oh, you are going to dispose an asset or a building in December this year. But we are in May, you decide to acquire a new building. By the time you dispose in that December, you're actually allowed to claim relief that, oh, part of the proceed you are going to get in that December is assumed that that is what you use to do the investment you are doing now. But for shares, it's not the same. For shares, the law provides that if you are reinvesting, you must reinvest within the same year of assessment. And year of assessment for capital gains tax purpose is on actual year basis, which means if you sell your shares in 2022, you must reinvest before December 2022. Now, how do you deal with situation where somebody disposes his shares, let's say, on 30th of December in a particular year, and the person is expected to reinvest before the end of the year? How do you deal with that? So if the person then is able to reinvest, let's say, in January or February the following year, he's going to pay tax. So it's a challenge. Another challenge again is that the law did not also provide for it. How do you determine the value of unquoted shares? For quoted shares, when you invest in a quoted company, at least the price of the shares, they are all publicly known. You can always go to stock exchange data and find out. But for unquoted businesses that you want to dispose, the Act did not provide how you are going to determine the price of those shares when you want to sell. And if you then fall back on the accounting provisions or standard to determine the price, accounting standards provide like 5 different methods that you can use to value a business. So I can decide to take, let's say, net assets approach to say this is how I want to value my business. Tomorrow taxman comes and say, no, I don't agree with this particular method. I'm using another method. And if you use these different 5 methods, you are going to have different 5 answers. So that on its own is going to create a kind of dispute between the tax authority and the taxpayers when the time comes. Okay? There is also issue of illusionary income. Somebody invested last 5 years. Let's say invested 100 million. He's selling today for 200 million. If you look at 100 million 5 years ago and 200 million today, you say the person is making gain of 100 million. Has the person really made gain?
In one word, let's wrap this up. Time is fast spent already. What's your advice to investors as we wrap up this discussion?
For my advice really to investors is that, number one is that because of all the issues that may likely come up, number one is that ensure you keep appropriate records of your investment. When you are investing, keep all the necessary documents that, because tax is about documentation. You need to have documents to support whatever you are doing. Keep that. The other advice I also need to, I have for investors again is that if you want to sell your shares, and the intention is that if I sell this share, I want to reinvest, then you need to plan. Considering that you must reinvest within the same year of assessment. So if you want to reinvest, then you cannot be thinking of disposing your shares in December, because you are going to be caught up with the deadline of you must reinvest before the end of the year. So you need to plan. What date, what time of the year should you dispose? And again, the law also provides for filing of returns. You must file your returns, because if you don't file returns, you are going to pay penalty by the time the person, the tax authority discover that, oh, you've actually disposed shares or you have transaction without filing. And of course, if you have tax to pay arising from gains from such a disposal, ensure you pay it within the time frame provided in the tax law, because failure to pay that may attract another 29% of the gain, in line with the provisions of the Capital of Companies Income Tax Act. So my advice to investors, like I said, ensure the law is there, ensure you obey.
I think we'll still have a part two of this discussion. It's really very interesting. I've been speaking to Mr. Fidelis Chukwudi. Interesting conversation. He's a senior manager, head of advisory tax pricing, transfer pricing, I beg your pardon, at Pedable Professional Services. Thank you so much. I do enjoy your weekend.
Thank you. Thank you.
All right, there.